Are you feeling the heat of your monthly payments? Student loan forbearance might be the perfect way to hit the pause button and catch your breath.
My name is May, and I achieved financial freedom after spending 13 years in corporate. I've partnered with Freedom Debt Relief to provide education around complex financial topics. Today, we're making everything chili crisp and scallion focaccia. Just like this dough needs time to rest, sometimes your budget does too. That's why I'm breaking down debt forbearance. Exactly what it is, how it works, and most importantly, how this pause affects your credit score. Is it a flavorful solution or just adding more heat? Let's get baking. Think of your student loan as bread dough. In this case, focaccia. The interest is the yeast and the oven is the due date. You have to put the dough in the oven, aka making your payments, on time in order for it to cook properly. By being late to the oven, the dough has overproofed and is going to collapse. Talk about messy. Student loan forbearance is like putting the dough in the fridge. It's a temporary postponement of your payments. Maybe you've had a job change, an illness, or an unexpected kitchen disaster in your budget. Forbearance lets you stop making payments for up to a set period, usually up to 12 months at a time. But don't forget, just because the dough is in the fridge doesn't mean that the yeast stops growing. In most cases, interest is still accruing. When you finally take that dough out to bake it, your loan balance might be significantly fluffier or more expensive than when you put it in. Pro tip, to minimize the amount of interest accumulated during forbearance, try to pay the interest off each month. Even if you can't pay it off entirely, any money you put towards interest will ultimately lower your total repayment amount. So how do you actually do this? You don't just stop paying. That's a recipe for default. You have to contact your loan provider. Most of them have an online portal where you can apply for a general forbearance. If you're facing financial hardship, you'll fill out a form, provide proof of your situation, and wait for approval. While this is a great tool for short-term survival, remember that it's different from broader student debt relief programs or income-driven repayment plans. Student debt relief is often about long-term solutions or forgiveness, whereas forbearance is just a pause. If you're looking for a permanent fix, you may want to look into relief programs first, because forbearance is a temporary band-aid, not a cure. Now let's talk about the big question. Does this ruin your credit? The short answer is no. Simply being in forbearance does not ruin your credit score. Your service provider reports the account as current. However, because the interest is still growing, your total debt or your credit utilization may go up. If your balance increases significantly, you may see a small dip in your credit score over time, but it's nothing compared to the damage of a missed payment. The goal here is to protect your credit by proactively pausing it, rather than just letting the payment go late. Forbearance is a powerful tool, but it's one you'd want to use sparingly. It keeps the dough from overproofing while you handle a crisis, but remember, the yeast or interest never truly sleeps. If you're considering student loan forbearance, make sure you have a plan for when that dough comes out of the fridge and it's time to bake. If this analogy helped you understand student loan forbearance, hit the like and subscribe button below. If you're looking for more debt resources to help with unsecured debt, go to freedomdebtrelief.com. They've resolved over $22 billion of debt for their members. Keep in mind, they can't handle federally backed student loans or secured debt, but they can help with other unsecured debt. Let me know what I should make next in the comments. See you next time.